We all dream of seeing our savings multiply, but only a few truly grasp the might of the secret weapon in our financial arsenal: compound interest. So what's the buzz all about? Compound interest isn't merely a buzzword thrown around by financial experts. It's the age-old secret that has turned many diligent savers into multimillionaires. Imagine not only earning interest on your initial savings, but also on the interest that builds up over time. In simpler words, it's the art of making your money work so hard that it too earns its own money. Consider this: you save $100 at a 10% annual interest rate. By the end of the year, you're looking at $110. Now here's where the magic happens. The next year, you're not just earning interest on your original $100, it's on the entire $110. Astonishing, isn't it? The tragedy is that many overlook this financial gem. But once you harness its power, especially over extended periods, you're on a path that might just end at a seven-figure destination. So stay tuned as I unravel the intricacies of compound interest and share insights on how to maximize its benefits. Tip number 1. Start early. What is the secret to unlocking the full potential of compound interest? It's time. Just as the finest wines need time to mature, so do your investments to truly blossom. Imagine sowing a seed in the most fertile ground. With dedication and patience, this tiny seedling becomes a towering tree laden with fruit. The same principle applies to your investments. An early start allows compound interest to weave its magic, accelerating your savings growth in ways you hadn't imagined. It's not merely about the principal you invest, but the continuously growing interest that's layered on year after year. Picture a snowball. Small at first, but as it barrels down the hill, it gathers momentum and size with each rotation. But starting early does more than just amplify your wealth. It paves the way for genuine financial freedom. By establishing a robust foundation, you become well equipped to navigate the unpredictable waves of life and economic tides. This foresight doesn't just offer stability, it ensures your financial aspirations remain tangible no matter the challenges. Furthermore, as your investments flourish, they open doors to myriad opportunities. Ever dreamt of being your own boss? Well, your investments can fuel that entrepreneurial spirit. Or perhaps you envision a life free from the daily grind, where early retirement lets you pursue passions at your own pace. At its core, investing early grants you the liberty to design a life defined by your aspirations, not solely by your bank balance. So why wait? Dive into the world of investing now and let time do the heavy lifting. Your future self will thank you. Tip number 2. Choose the right investment vehicles. When considering your investment strategy, it's crucial to select investment vehicles that align with your financial goals and risk tolerance. Fortunately, several options offer the opportunity for compound interest, which can significantly amplify your wealth over time. These options include fixed deposits, mutual funds, the public provident fund, and tax saving schemes. Each of these choices allows your initial investment to accrue interest. As time progresses, this interest begins to earn its own interest, resulting in exponential growth. For example, banks provide fixed deposits as a secure option where you deposit a specific amount for a predetermined duration at a fixed interest rate. The interest earned is added to your principal amount, leading to compound growth. However, fixed deposits generally yield lower returns compared to other options. In contrast, mutual funds pool money from various investors to form a diversified portfolio of securities. The returns from these investments contribute to the fund's growth, leading to the benefits of compounding. However, it's vital to understand that the risk associated with mutual funds can differ depending on the assets they encompass. The Public Provident Fund, or PPF, is a government-endorsed savings scheme aimed at providing long-term financial security. PPF accounts offer compound interest benefits since the interest earned on the deposited amount is reinvested, earning further interest. These accounts have a lock-in period, making them suitable for individuals with long-term objectives. Lastly, tax savings schemes such as equity-linked savings schemes offer both compounding growth and tax benefits. Investing in these schemes can lessen your tax liability while enabling your investment to expand. It's essential to approach these investment options with a comprehensive understanding of the risks and potential returns each offers. While compounding can be advantageous, it doesn't guarantee substantial returns, and every investment involves some risk. Diversifying your investment portfolio across various vehicles can help spread risk while maximizing potential returns. By meticulously evaluating each investment option, recognizing your financial goals, and gauging your risk tolerance, you can make well-informed decisions that resonate with your overarching investment strategy and objectives. Once you pinpoint an investment option that aligns with your financial aspirations, ensure that you, tip number 3, invest regularly. Even if you start your investment journey early, investing regularly is the best way to fully harness the power of compounding. Whether you choose to invest monthly or annually matters less than the act of continuous investment itself. By consistently adding to your investments, you ensure a steady stream of contributions that will benefit from compounding. Think of it as fueling a fire. The more wood you add, the bigger and warmer the fire becomes. Similarly, the more frequently you invest, the greater the potential for your wealth to grow over time. In today's digital age, automation has revolutionized many aspects of our lives, including investments. Setting up automated transfers to an investment account can help you maintain discipline in your contribution schedule, eliminating human tendencies like hesitation or forgetfulness. By automating, you guarantee that a specified amount is regularly transferred to your investment account without manual intervention. This not only saves time, but also ensures you capitalize on the power of compounding, allowing your money to consistently work for you. Tip number 4, reinvest dividends and interest. This strategy maximizes the benefits of compounding investments. When you receive dividends or interest from your investments, instead of immediately converting them into cash for personal use, consider reinvesting them. By doing so, these additional earnings become part of your initial investment capital. Consequently, these earnings also generate their own returns, enhancing the compounding effect. In simple terms, your money starts earning on top of what is already earned. Thus, your total investment grows due to both your original contribution and the growth from reinvested earnings. Conversely, if you withdraw dividends and interest, you miss the opportunity for those earnings to yield further returns over time. Reinvesting ensures your investments keep working for you, amassing wealth at an accelerated rate. In the long run, this approach can significantly affect your overall returns and help you achieve your financial objectives more efficiently. Tip number 5, stay invested for the long term. Compound interest isn't a quick or immediate money-making strategy. It demands patience and a long-term perspective. Benefiting from compound interest isn't about making hasty, short-term decisions. Instead, it centers on long-term commitment. Instead of trying to pinpoint the ideal moments to buy or sell assets, known as timing the market, it's more about maintaining a consistent presence in your investments or time in the market. When deciding where to invest, prioritize solid and stable assets. Predicting which assets or companies will prosper isn't always straightforward, but by concentrating on strong and well-established entities, you increase the likelihood of consistent growth. As these businesses thrive, the broader economy tends to benefit, resulting in an overall positive trend in the market. Moreover, avoid withdrawing your investments prematurely. Just as a tree needs time to bear fruit, investments require time to mature and deliver significant returns. Take inspiration from the renowned investor Warren Buffett and embrace the buy and hold strategy. This approach emphasizing investing in companies that pay dividends. You can then reinvest these dividends to amplify your growth or use them as a regular income stream. By resisting the temptation to access or utilize your investments early on, you can let the compounding effect markedly enhance your total returns. Tip number 6. Educate yourself. Lastly, to benefit from this strategy, you must understand the fundamentals of compound interest and other financial concepts thoroughly. Continuously educate yourself using resources such as books, seminars, workshops, and online platforms. The more knowledge you acquire, the better equipped you'll be to make informed investment decisions. Also, always stay abreast of market trends and review your investments periodically to ensure they align with your objectives and the level of risk with which you're comfortable. If your assets aren't performing as anticipated or no longer align with your goals, don't hesitate to adjust them for better outcomes. And if you ever have doubts about where to invest or how to move forward, consider consulting a financial advisor. Such an expert can help devise a specific investment strategy tailored to you, harnessing the power of compound interest while taking into account your financial situation. Well, that brings us to the end of the video. Thank you for watching and staying with me till the end. If you have any comments or thoughts you would like to share, please do so in the comment section below. Until next time, have a great day.